investment meeting. This is the New York City Fire Pension Fund investment meeting. We are at One Battery Plaza, 9th floor in the conference room. Some attendees are participating via Zoom. Today is June 22nd, 2023. It is 10:01 a.m. Mr. Dunn, will you please start the roll call?
Thank you, Madam Chair. Good morning, one and all. For Mayor Adams.
Kevin Liu for Mayor Adams.
Okay, and for Controller Lander.
Allison Hirsch for Controller Lander.
John Dorsa, alternate designee for Controller Bradley.
For Finance Commissioner Nybart.
Sean Ray for Commissioner Nybart.
Okay, for the UFA, Mr. Andrew Ansbro.
Bobby Eustace for Andrew. Bobby Eustace for Andy Andrews.
Okay, Mr. Eustace.
Mr. Eustace, President.
Mr. Edward Brown.
Bobby Eustace for Eddie Brown's proxy.
Mr. Eric Bischoff.
Eric Bischoff, virtually present. Good morning, all.
Good morning. And Mr. John Young. Pete DeVita, are you on?
Well, I'll take Young's proxy at this point until he joins us.
Okay, Eric Bischoff for John Young. For the UFOA, Mr. Christopher Jensen.
Here.
Mr. William Guilfoyle. Mr. James Brosey.
Here.
Uh,
And for Commissioner's office,
Lizette Christoph here.
we have a quorum.
Great. We'll start with the public agenda. I'm going to turn it over to the Controller's office.
Yes.
Great. Thank you very much, Commissioner. Hope everyone is having a wonderful morning. We have two items that we're going to discuss in the public session. First will be the quarterly report delivered by the Chief Investment Officer. And we also have a risk report or a risk update rather that will be delivered by the Chief Risk Officer. So with that, we'll turn it over to Steve Meyer to walk us through some slides.
Can you hear me, Kate?
Okay, we can hear you now.
Sorry, I apologize. You can advance one slide. I was just reflecting that inflation here and abroad continues to dominate headlines. US CPI is down by over half. Remember, it peaked last June at 9.1%. It's about 4% in April, which is obviously some great progress. That still is relatively high, given the Fed's 2% inflation target. And the Fed's preferred inflation measure, the core PCE deflator, has been sticky at the mid 4% range for quite some time. On the next slide, you can actually see that in yellow. Core PCE deflator continues to be about 4.6%, and that's problematic for the Fed. Fed Chair Powell was given congressional testimony yesterday, and although the Fed has opted to pause the rate hike cycle last week, it looks more like a skip, and the market is pricing in about a 60% chance of another 25 basis point rate hike in July, followed by a 40% chance of another rate hike of 25 basis points in September. On the next slide, you can see inflation around the world has been edging lower, particularly in the US and the Eurozone. The one exception here, however, is the UK up top in the dark gray. They have had 4 straight months of CPI coming in above expectations, which led to their 50 basis point rate hike today. There's probably a lot more for the Bank of England to do in terms of raising rates. And right now, the forecasts are looking at the rates at 5% now, potentially going as high as 6.25%. So again, exciting times in the fixed income and the financial markets. On the next slide, U.S. employment continues to be very strong. Average monthly job creations over the last 3 months have been over 300,000. The unemployment rate in May dipped up I should say, didn't dip down, it moved up to 3.7%. That's up from its 53-year low of 3.4% the prior month. But weekly and initial claims reports are actually starting to come in higher than expected. And we saw evidence of that again this morning. On the next slide, just a look at the employment rates. I'd say the one takeaway from this slide is the participation rate in yellow. It's actually moved up nicely since the pandemic, but it's still about 1 point below where it had been pre-pandemic at about 63.6. And that could be leading to some of the labor market shortages that we're experiencing now, putting upward pressure on wages. On the next slide,
It's a little fast and a little unclear. Sorry.
that's okay. Do you want me to start over again?
No, just if you could slow down a little bit. The audio is a little unclear. Thank you.
Got it. Sure thing. The economic growth in the US continues to be a tepid 1.3%. That's revised up from 1.1%, but still positive in the first quarter of this year. The US growth has been supported by a resilient consumer and strong service sector spending. In China, the reopening post-pandemic was met with much fanfare and great expectations for being an engine of growth for the Pacific region and perhaps the world. However, China's growth is actually slowed down to slightly below 5% versus expectations of 5.5% to 6%. So they're continuing to struggle. The Chinese central bank last week actually cut rates and put in place other measures to support economic growth in that economy. On the next slide, we can just go through this quickly. You can see that growth rates are converging in the low single digits on the far right-hand side. So that's evident of the fact that we've had rising rates in many of the developed economies. It's starting to take effect on growth. On the next slide, across the US, we've had very slow progress with workers returning to the office. New York City office use is still less than half of what it was pre-pandemic. Obviously, it's a confusing slide, but you can see across the number of cities in the US, the return to work is certainly below 70% of what it had been pre-pandemic. Similarly, on the next slide, a look at the New York City subway system ridership, which is just about 70% now of where it had been pre-pandemic. And I'd say equally important in San Francisco, the use of the subway system there, the BART system, is still less than 50%. So again, some still scarring associated with the pandemic in terms of people returning to work and getting back to their cities.
Not to mention getting nice stairs and going on the truck.
That too, although I ride the subway every day and I haven't had any bad experiences in the last year.
I would say, BART system, I was there, I know people work on the design. It's a regional system. It's not an intercity system. It is an intercity, it's not an intra-city system, whereas New York subway system definitely.
Fair points. On the next slide, last week, as I mentioned earlier, the Fed paused or skipped raising interest rates after 10 consecutive hikes over a 14-month period. The Fed summary of economic projections, so the dot plots, actually indicated that there are probably 2 more hikes coming, and I mentioned the being priced in on Fed fund futures for July and September, and that's in concert with Powell's remarks yesterday and probably this morning at 10. The ECB and the Bank of England continue to raise official interest rates. As I mentioned earlier, the Bank of England hiked 50 today, and there's more to do on both fronts. Maybe skip the next 2 pages, 2 slides. One more, Kate, please. Thanks. U.S. Treasury yields have moved up in the second quarter. This is due to a number of issues, higher Fed policy rates, positive economic growth, and sticky core inflation, which I talked about earlier. Credit spreads and high yield and investment grade corporate bonds have actually come down since widening following the regional bank challenges in the first quarter and early part of the second quarter. But as we approach the potential for a recession with increased defaults, those levels are likely to widen from where they are today. On the next slide, big news this morning as well, and that the 2-year, 10-year spread, the inversion is actually now a little over 100 basis points. It had been significantly lower in other parts of the year. The inverted yield curve basically indicates the fact that the market expects a recession at some point in the future. That timing is uncertain. And basically, a yield curve inversion is when 2-year yields are at, say, 4.75 and 10-year yields are 3.75, which is approximately where they are today. Typically, you get a premium for investing out longer term. The 2-year yield is much more sensitive to interest rate policy by the Fed, whereas the 10-year yields are driven more by inflation expectations and growth. In the next slide, just a look at a chart of where those 2s and 10s are. You see again, the 2 years been much more volatile. In fact, 2-year yields have moved up 100 basis points since early May. Next slide, a look at credit spreads. This is just a fancy way of saying what you're getting paid for, taking the additional risk of below investment grade in terms of high yield. So relative to comparable US Treasury yields, you pick up now 408 basis points in high yield. That's down a little bit from where it had been earlier in the year. It's actually up about 10 basis points today, given the recent sell-off in equities. On the next slide, the dollar continues to be somewhat strong, although it's been a little more volatile this year. Economic growth and interest rate differentials are currently driving and favoring the US dollar, although as other central banks raise rates, that differential will probably reduce and perhaps we'll see some weakness in the dollar as a result. The dollar also continues to benefit from its reserve currency status. Well, I actually, the question was from Liam, just about the status of the US dollar as the reserve currency for the world. And knocking off the pedestal, you're either talking about the Eurozone or more importantly, probably China. And I suspect, given the fact, and this may be controversial, but there was somewhat of a weaponization of the dollar following the invasion by Russia, Ukraine, in terms of locking up those funds. So if you're Russia, if you're China, if you're Iran, you probably want to have less deposits in dollars and holdings in dollars. But I do think that the US dollar is such an important mechanism for executing international commerce that probably would take some time. Although if you looked at the chart, you can see that the reserve currency and the holdings of dollars around the world have come down. I mean, Ed and I have debated this and we have differences of opinion. I worry about it longer term because I do think as the reserve currency status of the dollar is diminished, it may make it harder for us to roll over our debt, which is becoming, I think, a challenge given the level of debt we have outstanding. Sure. This chart just basically shows where euro relative to the dollar was. It's at 110 today. At its peak last year, each euro only bought 97 cents. The second chart is pound sterling versus US dollar. At its peak of the dollar last year, this pound sterling only bought $1.03 and now buys $1.27 today. And lastly, the US dollar at its peak last year was buying over 150 yen. It still buys 138 yen, so it's a favorable exchange rate. But remember, the Japanese central bank still has negative 10 basis point official rates, and they're still implementing yield curve controls to keep rates low. On the next slide, a quick look at where we are with stocks and bonds. U.S. fixed income assets continue to be attractive given higher base rates, base interest rates, and wider credit spreads. In the global equity portion of the market, we've seen a rebound in 2023 year to date. We've also seen some aftermath associated with the debt ceiling resolution. That will probably play itself out in the latter part of July or early August as the Treasury continues to issue upwards of $1 trillion worth of T-bills to replenish the Treasury's general account. It got as low as 40 billion. It's typically about 600 to 700 billion. And as they replenish that, there could be a drain in reserves and create a tightening of credit conditions. On the next slide, a look at world equity markets year to date. On the far right-hand side, you can see that there's been some nice appreciation. The NASDAQ 100 index in particular, the third one down, you can see it in dollar terms, it's been up 31%, 31.5% year to date. So a nice recovery off of a very challenging 2022. And you can see there's a lot of green on the screen, and that's evidenced by the fact that we have 15 returns associated with our European holdings. Nikkei up in local terms, 29%, in when it's converted back to dollars, just 19.8%. So again, some benefits associated with diversification in our equity portfolios. On the next slide, I'll look at sovereign yields year to date. Say the one outlier here, most yields have moved down. Our yield started at 388 this year. They've been all over the place in 10-year treasuries. They are now at about 375, so down a little bit. The one outlier here is UK gilts, the 10-year yields. You can see that towards the middle of the page, it's up about 74 basis points year to date. Is again associated with high inflation, sluggish growth, and rising interest rates there. On the next slide, quickly looking at volatility. Volatility in equities on the left-hand side has been fairly muted, as measured by the VIX. The VIX averages over 30 years at about 19. The volatility has been, for some reason, muted. Today, it's actually below 14. So again, some calmness in the equity market. Alternatively, we've seen a little bit more volatility on the right-hand side. That's the MOVE index, which is an indicator of volatility in U.S. treasuries. And that still remains elevated following, again, a very challenging 2022. Market returns on the next slide. You can see that we've had a nice recovery in global equities on the left-hand side. And on the right-hand side, it just really indicates further the challenges that the Bloomberg aggregate fixed income index had last year. And this year to date, it's up about 2%. On the next slide, just an interesting slide about large cap versus small cap. This is actually the composition of the Russell 3000. The Russell 3000 is simply the summary of the Russell 2000 index plus the Russell 1000. Russell 1000 in green up top, those are large cap stocks. Those returns, however, have been driven by a small universe of companies, those being Apple, Microsoft, Alphabet or Google, Amazon, NVIDIA with the AI craze, Tesla, and Meta, formerly known as Facebook. All of these stocks are up between 40 and 180%. And another fun fact, the Apple stock market capitalization right now, it exceeds that of the entire Russell 2000 index. So all the Russell 2000 companies combined don't add up to the same capitalization that one company, Apple, has right now. On the next slide, some recent news. The regional bank disruptions we saw earlier this year are calm for now. I would not be surprised to see that continue to be or reestablish itself as a concern down the road. I do think we'll see bank consolidation coming as regulatory costs increase and the need for stronger deposit bases increase as well. And just a couple more fun facts. 25 years ago, the U.S. had 13,000 banks. Today, it has just 4,000 banks, but that is still very high relative to global standards. On the next slide, just a look at the cumulative assets of the banking sector. And you can see the two black lines up top, the arrows. It points to the First Republic Bank of California, the second one to the Silicon Valley Bank. So the banks that actually appear on this chart to the right are potential banks that may have some difficulties. And I'd say that difficulties at this point manifests itself in a lower ability, willingness, and likelihood of them making new loans, which is adding to tighter credit conditions in the United States. On the next slide, I talked about the need for a stronger deposit base. This is a fascinating slide. This actually, on the lower part, you've got the yellow, which is the national average for bank checking account rates of return that are paid. And in blue, you can barely see the national average for banks paying in savings accounts. That is relative to the Fed funds target rate, where you can basically earn 5+%. If you buy 3-month T-bills today, you're in a 5.21% yield, money market yield, versus leaving your money in a bank and earning just 20 or 25 basis points. That's another reason why I think it's challenging for banks these days, that people can simply move their money with a phone call or the click of a button on their iPhone to achieve, upwards of a 500 basis point increase in yield. So that'll continue to play out, I think, over time. On the next slide, why don't we skip this slide? It's a little confusing. Basically, the gist of it is we think that we'll see high yield spreads move higher as we potentially approach a recession and a higher risk of defaults. And it may not be a bad thing. depending on what's priced in. Looking at performance, which is more important, I guess. Public market performance returns, you can see this is for the first quarter of this year, this calendar year. And the good news is the returns across equities and fixed income are all positive and all in green. I'd say the bad news is that we're still coming back from a very, very challenging 2022. You can see that over the course of the past 12 months, again, through the end of March this year, the returns are still negative. But again, we're trending in the right direction. On the next slide, just to look at FIRE's net public market returns. The good news there again is for the first 3 months of the year, they're all positive, they're all green. Equities returning 6.4%. World equity ex-US or developed market ex-US 11%, and so on. So a good result there, I think, so far in the short term. On the next slide, a look at FIRE's net private manager returns. Up top, you can see that for the past 12 months, again, ending the end of March, we've seen a 2.3% negative return with hedge funds. And again, they have a different function in your portfolio. Private equity, we have seen mark-to-markets that are typically occur with a lag, is now negative 3.9% for the past 12 months. And that includes marks through December 31st of 2022. Other private assets, core, non-core real estate, infrastructure, and opportunistic fixed income are still all in the green in the one-year sector. I think more importantly, if you look out on the right, 3s, 5s, 10s, and since inception, it's all green with positive returns.
When I see hedge funds,
In here.
Yeah, Liam's asking a question about the fees associated with the hedge fund returns.
correct. So like we're doing fees, we're getting 4.5, and I understand that our IPS limits how they invest. They're basically told, we want you to not try and take the risk to meet what an equity makes, but we also want you to beat what a bond makes. But at 4.5, you just said we can get 5% in the T-bill.
Yeah. Well, you don't know how long the 5% T-bills will last. It depends upon, it probably is likely to go up higher with another potential for 2 hikes. But at some point, those rates will cut. And you can see what happened in 2020 when the Fed cut rates very aggressively down to 0. So I think your opportunity on a longer term basis to outperform cash in a hedge fund, substantial. These are also, Liam, these are net returns. So these are after fees. But that's a valid point. It doesn't really look that appetizing since inception only on 4.5%. But again, remember, this is also at a period of time we had very, very low rates. Following the global financial crisis, we had 7 years, almost 8 years of 0 rates, moved up a little bit. And then for the last 2 years, they've been stuck at 0 until the hiking cycle.
Even if it's in the short term, de-risking standpoint, how you guys think about that?
Sorry, we can't hear the question.
I've tried to get this thing working.
Yeah.
Now we can.
The question was the risk reward
Hello? Hello?
characteristics of hedge funds. Sorry, relative to cash.
I don't know that this is working at all.
That we can hear that.
Yes, okay. Hear that. So
So the question that I was asking Steve,
Can you guys hear me?
Yes.
oh, okay, that's why, okay, all right, then I apologize. So just to clarify, I apologize. My question was just for edification purposes. I happen to say hedge funds, but I mean, even opportunistic fixed since inception, I know that there are parameters that every one of our investment strategies are given. But currently, we're making 5.2% on bonds, and there's really no fees associated with making. I'm curious as to the thought process at BAM on how they go about determining our allocation going forward, because we are going to be doing our asset allocation soon. And Steve was explaining that things can turn on a dime as they have in the past, and I know that hedge funds in particular protect us in a downturn. We lose less, for lack of better terminology, if these markets take it. So just trying to understand thought process on best ways to move forward with our asset allocation.
Yeah, and well, hedge funds also, and all the assets hopefully have uncorrelated or low levels of correlation with other assets. So you get diversification benefits as well that are there over time. So you want to minimize the exposure to drawdown risk associated with the portfolio, because if the drawdowns are dramatic, it takes a long time to recover. So you do want to have a diversified portfolio. So I think that still makes sense, but it's a good point. Right now, you can look at cash and say, well, cash is one of the cheapest assets. And I think a lot of people have come to that conclusion, and they've moved money into money markets or purchase agreements out of banks. But again, that can, to use your phrase, it can turn on a dime. It can react quickly on the downside when the economy is really sluggish, provided we're within target on interest and inflation, rates could cut substantially.
No, and so you understand where I'm coming from, like, when I first came here, my thought was, why aren't the targets for all of our investments
About 7%.
at least the discount rate? And, you know, so when I first saw that anything was making less than that, I'm like, why are we doing this if we're not making that money? But they're following our IPS.
Yeah.
And what we've told them to do. And so it's just, from my perspective, if we're making 5% in something that is pretty much risk-free.
Yeah.
Why not take that 5% and see what we can do? So I just more for
Yeah.
my edification than anything else.
When I think of and Doug, and see, you probably want to weigh in as well, but when I think of cash in a pension plan, I think of it as being more for short liquidity needs, meaning to meet benefit payments, to meet capital costs associated with private assets. It tends to be more tactical, meaning it's going somewhere else. But again, right now, cash is cheap. We have a zero allocation of cash under the guidelines.
Yeah, I mean, we had cash rates for a long time that were above 4% for 20 or 30 years, and then 10 years where they weren't. And so I think we're conflating it a little bit because we're looking at the last 10-year returns and saying that's not necessarily what we expect going forward. And the trade-offs are about the relationships between the asset classes, whether they're on the low side of the 7% or above 7%. I think as part of the asset allocation, we are revisiting the trade-offs that exist today, the T-bill, cash rates, other bond yields, which are much more attractive. You know, you talk about looking at the hedge fund portfolio and seeing a 10-year return of 4.6. The bond portfolio is a lot worse than that, right? So that's rear view mirror. The forward-looking stuff is when we're going to look at these trade-offs through the work we're doing right now in the optimization. And you hear us come in and talk about, well, should we do T-bills if the duration's very low, we're earning 4.5 or 5, versus what is our expectation for a 10-year treasury, 30-year treasury, and then hedge funds? I think that hedge funds will see an increase in their forward-looking return because rates are higher, and that's got to be factored into.
Yeah, it's also interesting. It depends on. It depends on who you talk to. I think if you talk to a high yield manager, they're going to say, put all your money in high yield now because you can achieve 8 to 9% returns. Private credit, 10 to 12% returns. So
Bring back Milton.
maybe.
I had a question related to that. I had a question from before, but related to this whole thing of cash. If you had a cash allocation, I'm wondering about the placeholder assets. Could they provide some liquidity? There's placeholder assets that are being invested, you know, typically across, you know, an equity index, or the Bloomberg Ag.
Yeah.
Although I'm wondering particularly in infrastructure, opportunistic real estate, where there is, you know, there are placeholder assets.
Yeah.
Because we're below target. That was just
Yeah.
one thought I had.
So those public market place or parking places or proxies, they're comprised of to equate to the returns expected in those private assets without the liquidity. So your point's a good one around liquidity. Liquidity is really not a problem for these portfolios. For Fire's pension plan, we have enough assets in equity and public fixed income, and we rebalance on a weekly basis. We sit down every Wednesday morning at 9. We go through what are the liquidity needs, what the flows look like, the key square redemption, for example, so, something that we need to factor into that consideration. So liquidity for this portfolio is not really an issue. You don't have an over allocation. You're probably lower below peers in private assets. So there's more than enough liquidity in the fund. But the proxies we tend not to touch the proxies, Shuman, only because they're trying to, and get us to the target return stream without that liquidity premium.
Can I make one other point? When we say we have a zero target to cash, and you're talking about T-bills, cash and T-bills, in my mind, are relatively interchangeable, right? There are some subtle differences. You do have part of your treasury portfolio in short treasuries, which to me are the same, a little bit longer duration. You've got, just looking at March, $550 million in the short treasury piece, right? So you get 4 pieces in your treasury portfolio, and then you do have 100 million in cash. So you do have cash, and you're taking advantage of the higher rates there. But as part of the asset allocation study, we'll discuss whether we want to shorten the duration and shift a little bit more to shorter treasuries because we're getting paid more to do so, and they have less interest rate risk. That'll be the big question.
Yeah. That's a great point, Doug. So I know Robert Fang is probably online. I'd ask him to weigh in. But we do have those 3 buckets, a long-term, intermediate term, and short-term bucket in the fixed income space. And Robert actually uses those 3 portfolios to actually manage the duration exposure. Robert, are you on? Am I on?
So Robert is on. Robert, can you hear us? Can you chime in?
We can't hear him, Kate, if he's speaking. Robert? are
He's
you there?
not speaking yet, no. Let's see. Oh, he's saying he can't seem to talk. Let's give him one more
Just
moment.
while we're waiting for, you had mentioned about we seem to be under allocated to alternatives, for lack of better terminology.
Some alternatives. So
Some
you're actually, we have a new slide which we'll go
Okay.
through in,
So talk about it when we get there.
executive session that actually shows the over and underweights. It's, it's something that Dan Haas has put together. We thought would be more informative. Right now, you're actually overweight, private equity, for example, by I think 1.2%. And the others, you typically are a little underweight. So we'll go through all that in a little bit, but,
But now historically, we're underweight and were you saying compared to other pension funds?
peers, yeah.
And is that because of the basket clause?
I think that was part of it, that we had a
Okay.
constrained opportunity set. The basket clause has been increased, but there's a different dynamic, and Doug, I'd love for you and Ed to weigh in as well. As we go through the process of starting the strategic, we've been working on it for months, but the strategic asset allocation, it's a different environment now than when that basket clause legislation was passed to increase the amount of exposure. We can have those prudent, anything that falls into that prudent investment basket, meaning that base rates are higher, credit spreads are wider. There might be other ways you can do it in more liquid products to
Without
generate that
having
7%
And less fees.
and with less risk, less fees. Yeah. And Doug or Ed, sorry. I know Ed's been very thoughtful on all this.
Just a couple points here. So, the first point is just because we have more basket clause doesn't mean that we have to use it, right? To give us flexibility. I think at some time in the future, we'll take advantage of it as markets change and the ELC price. In the current environment, it's true that risk assets move to a higher level of yields. So presumably get more from private equity as well, but also the risk level of private equity also moved up, right? So if we were to max out on private assets from the basket clause perspective, we're also moving high in the risk level, which is not necessarily an optimal allocation, right? So historically, we've been relatively peers, right? It's like a lower private equity allocation. The future will show if it's a good move or bad move. But given the current yields we can get in the public markets, and given also the risk objective of the portfolio, it's probably a likely outcome that we will increase somewhat allocation to the privates, but not all the way to the 35% allowed by law. But again, it's a bit early. We just started the discussion, and I don't want to steal Doug's thunder, but we're still early in the process.
Thank you very much.
Thank you.
Hi, Steve. Question that,
Oh, hey, sorry, You might, Robert, did you want to comment on how you use the short, intermediate, and long-term buckets to manage duration?
Yeah, sure. Can everybody hear me okay? Sorry
We
about
can hear you
that.
fine, Robert. Thank you.
I had to access the microphone. So we have an overall duration for our treasury portfolio, and that's made up of the buckets that Doug was talking about. So we have short term. So what we are trying to do is we're trying to mimic the treasury curve compared to where the durations are. So what we do with the short term is it's part of our overall duration calculation. So the treasury portfolio, if we need to cash very quickly, the only place where we really can raise it, with the like liquidity in one day would be in the treasury portfolio. So what we would do is we would first move it out of the short term cash bucket, and to supplement if we didn't have any cash in the cash bucket. So the short term bucket has a 1 to 3 year kind of maturity, and with a duration around 2. So we would move it out, and then we would rebalance the treasury portfolio to match the duration of the treasury bucket. So that's how we kind of look at it overall.
Great. Thanks, Robert.
Thank
As I
you.
said, we sit down, we have a rebound meeting every Wednesday at 9 o'clock. We sit down for the better part of an hour and go through cash needs, where we are in liquidity, and we look at the balance of the assets in public space to make sure that we're not over or underweight. We don't take liberties. We don't take tactical bets. That may be something that the trustees empower us to do at some point down the road, which would, I think, take a different level of skill than we have internally and more insight into the markets. Meaning we don't see retail and institutional flows. We don't underwrite bonds and stocks. There are firms out there that have better information to make those decisions. But at this point, we try to stay in the efficient frontier. We try to stay with the targeted allocation that we have, that the trustees have agreed to and asked us to follow.
So just to remind folks, when we re-engage or as we re-engage in the IPS, there is a whole section, if you recall, where tactical trading was an issue that came before this board. There were many different opinions between a previous iteration in BAM and this board about how to handle that. And we did, and particularly in the bond world, and we did put language in the draft version that exists today that we haven't finalized that addresses tactical allocation and whether or not and what parameters and in practice what would happen if BAM were to exercise tilts on the portfolio or something. Like we've actually been proactive in putting in some language. So
Yeah.
we should definitely share that. And I think our reluctance to share that more internally is I think we want to make sure that we have everybody looking at the same document and make sure that we're all in the same place. So I would say the summer is a very good time for us as a board to reconvene those meetings about the IPS so that maybe we can come September, October and finalize a new IPS for the future of this fund to coincide with the strategic S allocation. So I'm going to just put that as our homework as a board.
John, can you remind me or us about the process of that? Was there a committee to do the IPS? What was the process?
Yes,
That was in place before.
Yeah, so there is a committee in place that was looking at it from the city side, the controllers representing the city side, as well as the fire commissioner, I think, might have also been involved. I'd have to check the meeting flow. And also the UFOA had a member, the UFA had a member. The mayor's office was less engaged because we were working off an original document that they had already had a strong hand in when it came to the other boards. So the setup of the document was refined.
I think Cindy was involved in that. After she left, I don't think anybody from the mayor's office has kind of been involved.
Was she? I guess she was. I couldn't remember.
Yeah,
But
she was
yes,
involved.
I would.
Yeah.
Jack was our rep.
correct.
Cindy.
Yeah, and Bobby was definitely there.
Yeah, Cindy was
And
there.
Cindy was
Yeah.
there.
But anyway, when there's process resumes.
It was Lucas and on, but it's with the trustees. So let us know So. I request it. Yeah, I think we will. And I just want to remind folks there were other circumstances that kind of, that stopped those meetings from being efficient. I'll just leave it at that. So I didn't want to bog this down with an IPS conversation, but I do think that we have contemplated the things that Steve is mentioning, and I think it's important as a board that we re-engage on. And I want to say NEPC did a tremendous amount of work on going through the document and trying to parse out the real pieces that the board collectively wanted to discuss. And I think that's really where the point we're at. And Doug, I don't know if you want to say anything more, but I think that's where we really kind of stopped, was towards the end, actually.
Yeah, I mean, it
We were at the
ultimately,
addendum.
it becomes a wordsmithing conversation. And so going through it, and we did try to pick it back up last fall and go through it again. And I don't think there are a lot of things that there's disagreement about. It's more the strategic asset allocation process should finish up. We'll get it all wrapped up with a bow. And what I envision that I think will help is we're going to have a cover memo to say, here are the things that changed, that were added, new. Here are the things that were deleted. Here are the things that are important for every trustee to understand about the changes. And, without characterizing, I want to be, NEPC should be the honest broker in the room, kind of characterizing and summarizing to make it more efficient, everything that's changed.
And maybe just to put a bow on things, if you remember, I had a slide when I first started about a year ago, and I talked about time in the market, not market timing. That was part of that discussion, and that I don't think we should try to time the market. I think it can be done. I think it can be done to the benefit of the pension plan. I think it's very hard to do. I think it's very rare. Unless you have a high conviction, you have the right skill level, insight, or outside manager to do that, I don't think you should be doing it.
You don't want to put me in charge of that?
Maybe just wrap up, because I know I'm long and we're short on time. On the bottom of the slide, I think more importantly, you can see the fire total return of 4.1% for the first quarter of the year. It's a pretty good bounce back from a challenging 2022. More importantly, in the 5-year, you've had a total plan return of 6.5%, and 3 is 10%. So that's what we should be focusing on, is deriving those long-term returns. On the next slide, just a look at the breakdown. We actually I'm sorry, prior slide, please, Kate, or Wilfredo. There is one thing worth noting here. You can see the fire policy return, the public market equivalent, the 65-35 split, that actually delivered 6%. What that tells you is there's been a little bit of a drag on the portfolio associated with the mark to markets of the 10% we have roughly allocated to private equity. Again, so a little bit of a drag in private markets relative to public. But again, that will revert over time, I believe.
Steve, is there any way to show us how our returns compared to other systems returns over the 5-year?
Yes,
Yeah.
I mean, 5 systems, Tux, peer reviews. Yeah,
I mean,
it
we're
does-
at 6.
Yeah.
I just want to.
So I believe in the actual quarterly report that is on the system, I believe that there is a slide, I believe there's a tuck slide that shows the fund in comparison to the broader universe. I think it's all funds over
Billion.
over $1 billion, but I mean, that's kind of a big world.
Yeah.
That used to be a small universe when I started, but the $1 billion number is not as small as it used to be.
20 years ago.
Yeah, a long time ago. So, but we do have that slide is actually, so it's on the controls website, it's in the pension library, it exists, but, but that's the question,
No,
you asked about the
just-
five
yes.
funds or.
I mean, I would we're looking at a discount rate of 7 over 5 years. We're at 6.5. I'd like to see how the others did. And if that boils down to an asset allocation question, this will. Great, thank you. Perfect.
Yeah, for anyone that hasn't looked at that website, it's fantastic. I know Allison worked on it with Kate Visconti, or chief of staff. It's really worth spending time on. I'm on it every day.
Sounds like O'Neill's asking for also.
we have elements of that as well, and typically, but yeah, I think it's probably where do you stack up relative to peers? Yeah. Great. Just in the interest of time, Kate, could you skip ahead 2 slides, please, to slide 35? Just a look at the return relative to, these are your excess returns and basis points. So on the bottom, you can see that you underperform your benchmark by just 73 basis points. A little bit of a drag associated with the equity returns relative to the Russell 3000, which has been strong in the first quarter, but positive returns and all the other asset classes. On the next slide, a quick look at the private market excess returns. Again, hedge funds struggled a little bit over the 1-year time horizon. Private equity, however, delivered 1,440 basis points of positive return relative to the Russell 3000. And you can see the only other area where there's a little bit of a drag in terms of underperformance was in non-core real estate or opportunistic real estate. And that had to do with the fact that it was more of a risk-off environment. Those assets tend to be a little riskier. Last slide, just a quick look at the asset allocation changes. Nothing really to note here. Cash, we need cash to meet benefit payments and capital costs for private markets. So we raised 95 million. 55 million of that went to make those payments. And 40 was done by John Mercerberg as he rebalanced the global equity portfolio and move more into international fund of funds. And with that, I'll open up to any other questions.
So that concludes Steve's quarterly. We have a risk update. I'm just looking around how we're doing on time.
You can do this in 5 minutes, or you can do it in an hour.
Yeah, I mean, we could do it in 90 minutes. We could do it in 5 minutes. We could do it. Yeah, you know. Okay, so
I just can give you a punchline. There's not much change since last quarter. That's the
Yeah.
punchline.
So let's go to the high level. Let's try to keep it between 5 and 10. And Ed will do the 5 and 10 version. And then if there are questions that come up in the room, please ask away. If there's questions or you want to come sit with Ed, you want to come sit with the team, guys, go for it. Like, I think the message here is people are watching this stuff in our office to make sure that risk isn't out of control. We understand what's going on. Markets are constantly moving. If you walk into Steve's office any day of the week, you know, a news channel is on. I don't want to give an endorsement of a news channel. However, he has been interviewed by Bloomberg News. So, you know, it may be on in his office all day, every day. People are on top of what's going on in the industry. People are watching what's going on. And I think you're going to hear that when you hear Ed's comments. I think that's the takeaway before you even start, is that folks really care about this stuff and are looking at this all day, every day. So
Just had three TVs going at the same time, so you want the 3 broadcast networks.
If I could just make one other comment, John, you talked about this up top, but Ed and I really want these to be valued. The entire BAM team, anytime we're in front of the trustees, we want this to be beneficial for you. So, you know, Ed actually said this to me out. He said, I don't know what hits you, but Ed redid all of his slides. So we really want feedback. And what do you guys want to hear? We try to tell you what we think is important, particularly around portfolio performance and positioning. We try to give a little more context in terms of what's going on in the world and the market and how that flows into your portfolio performance. But we don't know if we're really there. So we're open and really receptive of feedback. So please tell us whatever you want to see. We'll redo our presentations.
Make sure we have no questions from my end about how much work goes into this and how much people care. It's never an issue. Most of my questions are edification for my own sake. I look at stuff. I'm not a risk analyst by any stretch of imagination, and I certainly don't have your career. Just every time I do this, I want to learn something from it, and really just from that perspective that I ask my questions.
But also to continue the same theme, just to frame the point of this conversation. So it's very easy for me to rent out number of numbers, right? The whole range, risk this, risk that, volatility this. It will not really tell you much. It's not about the numbers, about the sense. And ultimately, you heard Steve's presentation, a lot happening in the world. You see the performance. But the question always like at the top of my mind, it's a really complex portfolio. What's actually happening in this portfolio? And the risk is a way to understand it and to catch the problems before they become problems, right? Because ultimately, so you have $18 billion, which is a lot of money. You have 72 public managers. You have over 300 private funds. You're holding over 5,000 individual stocks. It's a lot of complexity, right? And that's even before BAM does rebalancing, all the cash flows, all the needs. And the whole point of risk numbers, why we're doing this presentation, to give us some sense of comfort and everything is functioning as it should be. And even though the numbers may not change quarter to quarter, I think this information is important. And I think it's important for you to know that watching these numbers, and even though we distill this risk presentation to a small subset of numbers, we'll watch much more. And we'll be more than happy to get engaged in a broader conversation. But broadly speaking, the point, and I'll try to summarize in 10 minutes, the whole point is to give you a sense of the two questions. What's happening in the portfolio now in the current positioning, and what may happen going forward, right? So kind of frame your expectations, give you an idea what may hurt the portfolio, what may benefit. It's also helpful input, at least for us, for the forthcoming asset allocation exercise. Give us an idea where the risk and returns, where the trade-offs are, right? So that here gives more transparency at the portfolio. So let's just dive into it. I'll move fast. Please stop it. I need to slow down. That said, I mean, you've seen this page a few times. So on this page, we're trying to kind of get the really from a high vantage point to understand if the portfolio is functioning as intended. And here we use the prism of risk, and we define risk in terms of performance, specifically in terms of expected performance. And much like we always talk about two measures of performance, we talk about the total return, which ultimately is the most important return for the plan. That's the money the beneficiaries will get. But also talk in terms of excess returns, which is the skill of your managers, the liquidity premium. And even though it's a smaller part of the return, that's where we spend most of the time, right? And for the same reason, we talk about two measures of risk. We talk about total risk, which is really just the expected total return of the portfolio over the next 12 months within a certain probability range. And you can see on this table that the total risk at the bottom of the table is 12.2%, slightly down. And then we talk about active risk, which is the expected excess return of the portfolio over the benchmark over the next 12 months. You see that excess stands at 2%, slightly up, let's say almost unchanged. And to kind of roll it back again, slow me down if I'm moving too fast. We start with the market portfolio as our point of preference, which is simple 65-35 length of the MSCI ACWI Barclay US Ag. You can see in column 1 that the total risk for this portfolio stood at 12.3%. It came down for the quarter, and it's really just a function of markets. Steve just mentioned about a VIX coming down, the MOVE index coming down. So it's not surprising that the market portfolio is running at low risk. The policy benchmark, which is similar in terms of stock bond allocation, but that's where we split it into 11 individual asset classes. Again, you can see the risk level at 11.9%, slightly lower. That's the effect of asset diversification. And finally, you see that your portfolio runs at 12.2, again, closely aligned, slightly higher level, same story as the previous quarter. So I'm not going to dwell on it much. And again, focusing on the charts on the right-hand side, here we show the evolution of these three portfolio over the 12 months. What's important here is to see how the relationship between this portfolio changed or didn't change. You can see it's been fairly steady over the year. The risks peaked late last year, driven by market vol. As market volatility coming down, you see that the risks of all three portfolios coming down as well. So everything is functioning as expected. And you also see that the active risk chart number 2 is staying very steady at roughly the same level. So this is really your, from the very high vantage point, kind of an assertion that the portfolio is functioning as expected. It's aligned with the benchmark. I show you the performance driven by the markets. And it sounds like somebody has a question.
Yeah, I did about the active risk. Is more active risk good or bad? I think, like say at a manager level, I don't really understand a portfolio level. At a manager level, you have an active manager. You want them to take risks to get more alpha. You know, is that a good thing? I mean, is it directional? If you're having excess return, is more tracking error or active risk good or bad? And in a portfolio is my question.
We have a slide in a couple of pages, so I'll get back to this question in more details. The short answer, it needs to be consistent with your objective, right? So it's not a question of good or bad. You have certain investment policy, and you expect the managers you allocate to, the active managers, to do what they expect to do, right? So it's a question of portfolio construction. So I would say taking isolation, this question probably hard to answer, but when we look, and I'm sorry, I'll come back to this question. So I'm not trying to blow you off, but I'll definitely get back to this.
Thank you.
Because
No
it
need
is
to
an
come
important
back.
question. It's
thank
coming
you.
anyway, so. Oh, if you don't want it, we can definitely skip. That's for sure. So diving into a little bit more to the risk, as I mentioned, that was a very high vantage point look. Obviously, it's much more complicated than that. And Kate, can we have the next page, please? So first of all, let's focus on total risk. Again, it's a measure of total return on the portfolio. And what you see on the left-hand side of this page is the chart that must be fairly familiar to everyone. It's the asset allocation or the market value view of the portfolio. So obviously we have the three broad buckets: public equity, public fixed income, and alternatives. So hopefully no surprises. And of course, we have cash running about 60 basis points, the thin red band, subject to many discussions, but it's an off benchmark allocation. What you see on the right is a slightly different view of the portfolio. This is what we'll call risk allocation. And what it shows you is the contribution to your portfolio based on the risk levels. Why it is important? Ultimately, the performance of your portfolio, be it the upside, which we want, or downside, which is less desirable, will be driven by the risk levels and this distribution of the portfolio. And you can see that, for example, public equity, which used to be 43% exposure, now becomes a 64% risk level. You see that the single most important allocation of your portfolio is US equities. It's 44% of risk. And fixed income, something we also spend a lot of time talking about, is responsible for about 7% of risk exposures. You may also say that your intuition about the performance of your portfolio doesn't connect with this chart, and this is true. That's what your portfolio would have looked like if BAM went on a long vacation, and if we skipped our Wednesday morning rebalancing meetings. But the fact remains, we religiously balance your portfolio at least once a week. And this chart shows you the importance of this rebalancing. And that's why it's probably one of the key parts of the investment process. That's that. It's also important to keep in mind because it frames your, should frame your expectations for the future upside, but also for the downside and drawdown in the portfolio. And finally, can we have the next page, please? I keep saying that risk and performance should be used not interchangeably, but they're very closely related. So it's important to connect our risk forecast with the realized performance. And first of all, it's important to affirm the integrity of our risk models, because you need to be comfortable to know that what I'm telling you is actually grounded in reality. But also, more importantly, it's a check on the asset allocation. Even though we do it every 3 to 5 years, we're currently undergoing this exercise, but it's something we monitor in real time. And if there's a problem with asset allocation, something we definitely will highlight to the board and will bring up to your attention. With this in mind, just walk you through the charts. It's a new chart for this quarter. The vertical bars on this chart represent the 3 months risk forecast, meaning that that's how a risk system sees the performance within a 68% probability. So it's about a 15% chance to be over or 15% chance to be under. And the triangle represents the realized return for the first quarter. Starting with chart number 1, on the left-hand side, you see your portfolio, and you can see that the realized return is comfortably within the risk forecast. So no fireworks here is good. You see that for all 3 broad buckets of assets, the same thing holds. Public equity, public fixed income, and alternatives, the realized performance is well within the expected range. So it's a good chart. Chart number 2 is the 3 months performance for alternatives, and it needs to be taken with a grain of salt, right? We included here for completeness. We know that the performance for alternatives is getting restated and probably will. It's just a preliminary to give you a sense. That's that again, you can see risk forecast and that's with the performance. It's a little more interesting chart number 3 when we look at public equity markets. The only notable observation is developed ex-US. You can see that the performance slightly exceeded the risk forecast. And as I mentioned before, it's within the 15% probability expectation. There's several reasons why Europe outperformed the rest of the world, at least the United States. Part of it is due to China reopening, which a little bit stalled since then. And several European economies rely heavily on China exports, Germany in particular. There's a value bias in the European markets, and value tends to perform better in the inflation environment. And also this domestic US banking mini crisis with a little bit of dampener on domestic returns. That's how you can see, again, we're not talking about huge outperformance. And public fixed income chart number 4, you can see everything as expected. So it's a chart. Moving on towards active risk. Look at next page, please. I just want to come back to your question. That's exactly the chart I had in mind. It shows the composition of 2% of active risk. As you can see, the vast majority of it is about private assets. It's not surprising because private assets are benchmarked under Russell 3000 plus 300 basis points, which obviously public markets behave very differently, but you can see that active risk for public markets is very low by construction.
And this chart will suggest the active risk positive. As we heard.
Well, active risk is always positive. So active risk just shows you this. Is this a difference from the benchmark? The breakdowns, you can see that, for example, fixed income used to be a negative contributor, and this is because of the positive stock bond correlation. It shifted back to positive. Moving to the next page, again, we'll look at the performance. I'm sorry if I'm rushing. Please stop me if you want to slow down. Same exercise as before. We'll look at the excess returns versus active risk projections for the system over 3 months. And I'll start just on the notable observation, chart number 3. Everything else is in line. Chart number 3, public equities, developed ex-US. You clearly see that the realized return far exceeded the forecast. And that's something definitely something we'll look in. It could be a source of concern. It's not in the current case. It just happens so that each one of your active managers in this space delivered an excess return, positive excess return. And 2 of the managers, I'm not going to name them since we're in the public session, but 2 of the managers delivered excess return over 7%, which is extraordinary. That was not something new they did in the portfolio. It was their long-standing conviction, mostly because of the technology exposure. Again, the positions were taken long before this quarter. It's just their long-held views play out over the quarter. It's a 3-month picture, but again, the exposure, and I'm sure John Mersenberg is on the line, he can comment more. but the exposure was taken several quarters before that. It's long-standing conviction, and these managers typically do not have a high turnover in the portfolio, so they take exposure and they let time to kind of run its course. All right, so so far we talked about the risks as it stands today. Now we'll spend a little bit of time talking about the potential future exposure. We have the next page. And again, the future is obviously unpredictable. I cannot pretend I can give you a complete set of future scenarios. It's impossible. So we distill it to just 9 scenarios. We'll look at equities and rates as the obvious dimensions of risk for your portfolio. And of course, the commodities, which is a bloodstream of the economy. Commodities determine everything and inflation. And in each of these categories, we picked the most important 3 factors. So for equities, obviously, the United States, emerging markets in Europe. For rates, it's the 2-year treasury, which is a proxy for the Fed fund policy rate. The 10-year treasuries, which is probably one of the most important real world rates. It's about mortgages, corporate borrowing, and everything else. And the euro-dollar exchange rate, chart number 6, it's a proxy for the US dollar. It's given the outsized importance of US dollars, the reserve currency. And finally, in commodities, you see the copper price, and copper is really a proxy for the global GDP. Copper goes into everything. The copper price is highly correlated with the outlook for the GDP growth. It's about oil, and oil goes into pretty much everything: manufacturing, transportation. Oil is critical for the economy. And finally, inflation, which is something we live through every day. And just pause for a minute at this chart. So we show here 4 years of history, which is roughly the amount of time that our risk system is using to come up with a forecast. And these charts tell immediately it's an amazing story. Starting with chart number 1, the S&P, you see the COVID shock, you see an amazing recovery that followed following the fairly unprecedented 5 trillion stimulus. You see how Europe didn't recover as much. They didn't have the benefit of the same stimulus. You see the emerging markets beginning to recover and stumble, mostly because of China, which is facing multiple challenges. And then in the commodities world at the bottom row, you see much of the same story, like copper dips as COVID starts taking its hold. Copper beginning to recover, mostly because of the optimism about the future economy recovering. And then it's stalling, and it's stalling again, mostly because of China, because China is one of the largest users of copper. And similar story in oil prices, oil going. These are the forecasts of our system. I was just about to comment on that. So looking at these charts, we asked the question of our system: what will be the worst monthly shock over the next year? And these are the ranges shown for each of these 9 time series. We're showing the forecast. So we don't know it will be up or down, or we know that each of these 9 charts show a large amount of volatility. That's why these ranges are very high. What's important, these ranges look a little bit arbitrary, but each one of them has the same probability of happening. And that's what's important. And that's, we'll see it on the next page. Then we'll please move to the next page. Thank you. So we applied these 9 shocks to your portfolio, stressing markets up and down. And we'll do the same for the benchmark. So altogether, it's 36 stress tests. And much like mentioned throughout the entire presentation, talk about absolute return and excess return. Both are important. They tell a little different story. And we give you risk on scenario, everything rallies, and risk off is a sell. And you gotta keep in mind that all these scenarios have the equal probability of happening. So just by comparing the numbers, you can see the exposure of your portfolio to the stress shocks. So starting with equities, it's not surprising that the most important shock is the S&P, the domestic equities. It gives you the largest move. Maybe somewhat more surprising that Europe is not that far behind. It's almost 15%. And it's not because Europe has a large allocation in your portfolio. It's because a lot of domestic companies derive a large share of their revenues from international operations, right? So Apple is nominally an American company, but I would argue it's a global company. You can also see that exposure to emerging markets, which mostly China, is actually low. And that's not necessarily a bad thing, simply because of all the transitioning happening in the Chinese economy and all the challenges they're facing and likely to face going forward. So you can see that the exposure to rates is actually low. So your portfolio is not that sensitive to Fed fund policy, but the dollar plays an outsized role in your portfolio. And the weakness in dollar is actually beneficial to the portfolio. And finally, on the commodity side, it's copper that dominates exposure. So putting it all together, the punchline is that your portfolio is positioned for the global GDP growth. You can see it through the dollar exposure, through the copper exposure, and through exposure to the domestic equities. It's also important to notice that your portfolio shows what we call a positive convexity. So it's a fancy term, says that your portfolio gains more on the upside than it loses on the downside. It's a small effect, but you can see that the risk on is slightly larger than risk off. It's a desirable outcome. And if it were to turn the other way around, it's something we'll flag as a problem and we'll look into it. And finally, back to the question about active risk, you can see that excess returns are actually well controlled. They're not huge. So we don't expect your managers going forward to have an outsized returns. And finally, just spend 1 minute on the next page. Since we've been talking about it for several quarters, we just show here the time series, how these risks evolve over the time. The only notable observation, chart number 1, you can see that exposure to Europe had a jump in the fourth quarter, and that's actually the repositioning of your managers will look into it. The rest of the changes are due to the markets. So I'll stop here for any questions. And sorry if I moved too fast.
Okay, I don't see any questions in the room. I encourage folks, if you have questions, certainly send them off to Ed and to Steve. So with that, I'd like to make a motion that we exit public session and enter into executive session to discuss specific managers. Is there a second? Or do you guys want to stay in public? Thank you. Mr.
Second.
Coble. Great, thank you, Eric.
Welcome.
Can Bam please end the recording? So Bam.
Okay, we now need a motion to close this meeting and start the firefighter variable supplements fund meeting.
So I'll make a motion to exit the public session of the police pension fund and enter the public session of
Did I
the,
hear pension fund?
of the fire pension fund. I'm really having a day. Yeah, I'm really having a day. Let me tell you something. Of the fire pension fund and enter into the firefighters variable supplement. Right. Well, we can.
I have no problem. If you want to bring them in. Whatever's easiest for you, bro. I have.
So let's do the VSFs and then we can always go back.
Yeah. Any opposed? Hearing none, motion carries. Fund meeting. We'll turn it over to Don for a roll call.
Thank you. For Mayor Adams.
Kevin Liu.
Okay, for Controller Lander.
Allison Hirsch for Controller Lander.
Okay, for Commissioner Nyblock Finance.
Shuman Ray.
And for the UFA, Mr. Robert Eustace. and Mr. Edward Brown. Okay, we have a,
So I would like to so note the quarterly report of the fighters variable supplement.
Great, thank you.
And with that, I'd like to make a motion that we exit the firefighters variable supplement fund and enter into the fire officers variable supplement fund. Thank you, Bobby, for second.
Any opposed?
No.
Okay. Any opposed? Hearing none, the motion carries.
So now we are in the fire officers
Officers.
variable supplement funds. We need to roll.
Fire Officers Variable Supplement Fund for Mayor Adams.
Cavalier.
Okay, for Controller Lander,
Allison Hirsch,
Commissioner
Controller Lander.
Commissioner Nybart,
Shimon Ray.
and for the UFOA, we have Christopher Jensen.
Here.
And Liam Guilfoyle. Arms and pain.
Okay, and we would like to note for the record, the receipt of the quarterly report for the fire officers variable supplement fund. So we have one additional item that has just come to our attention that relates to an investment matter. So with all due respect, we'd like to go back into executive to hear an update and then go back into public to adjourn. If that's acceptable to the board. Okay, so I would like to make a motion to exit public session and enter into executive session.
Any opposed? Hearing none, the motion carries. We need to stop the recording.
Thank
We are now back. Excellent. During the executive session matters, we now need a motion to adjourn.
I'll make a motion to adjourn.
Any opposed? Hearing none, the motion carries. We are adjourned. Thank you.
Thank you all.